you are famous as being the $10,000 gold man. You have called for $10,000 gold, and you've made waves on the internet with that call. And, people support your justification for why gold is going to hit $10,000.
But 10,000 sounds crazy, I know, but it's easy to get to. And that is, I look at gold not in terms of the dollar price of gold. Gold is the most stable monetary medium there ever has been. And that's why it's been money for 4,000 years. And so really it's a dollar moving around, not gold. Gold's pretty constant. I don't think gold goes to 10,000 in a vacuum. It means the dollar is going down significantly. So I think of gold in terms of the Fed's balance sheet. You look at that metric, how much what percentage the Fed's liabilities is backed by gold, and we're at a historic low of 6%. And this happened before. It happened in 1969. It got down to 12%. By 1980, it was at 100%. In other words, the gold price went to a level that made the Fed totally backed by gold. At that moment, in 1980, the market, not the politicians, not the economists, the market had returned us to a gold standard. Every dollar Federal Reserve note was backed 100% by gold. That will happen again, and those numbers are up in the $20,000 an ounce level. But that's a total liquidation of the Fed. That's the long term. We're going to get there. I mean, the first thing to do is realize that gold is money, right? As J.P. Morgan said, and nothing else. And so it's not that it is. You have to think about how high gold is going to go in a vacuum in dollar terms, and looking at the world through the dollar lens. It's gold is the stable thing. And people push back on that. What I point to is that if you look at commodity prices, it's not just they're more stable in gold terms over time, they're less volatile. So for example, if you price oil, which is the most essential commodity in the industrial age, in gold terms since 1971, when the US left the gold standard officially, it's not just that the oil prices are more or less the same price in gold terms as they were back then, as opposed to dollar prices, which are obviously much, much higher. But the rolling 12-month volatility is 40% in gold terms and 60% in dollar terms. In other words, so looking at the commodity lens through the gold, commodity prices through the gold lens makes the world make sense. And there's a reason for this. This is a long answer to your question, but I think it's important for the background. And that is that gold comes out of the ground. I mean, you have to expend commodities, oil, steel, rubber, labor, all the things to mine gold. And so when there's a scarcity of gold and the price goes up, marginal mines go into production and create more of it. And then when there's a surplus of gold or surplus of money and people don't want more money, then gold gets cheaper and the marginal mine shuts. But also expensive gold gets people to melt their jewelry down and melt it back into monetary form. And same thing, cheap gold gets people to go buy lots of jewelry. So there's two forces in the real world that keeps gold stable in terms of commodities, or rather I should say commodities stable in terms of gold. And every consumer product starts as commodities. And so if you stabilize price in terms of commodities, you're also going to stabilize at some level consumer prices. And the reason I think it warrants an explanation is because Bitcoin, for example, which is, a lot of young people think Bitcoin is the new gold. It has no relation to the real world. There's nothing that modifies its quantity to meet the demands of the market. The demand for money is not a constant. It goes up and down, and gold can respond to that. So that's a long-winded, actually short. Yes. I've got a 1,000-page book I can send you, but short and long-winded, same time, explaining why gold makes for good money. In addition to all the reasons we know, it doesn't oxidize, longevity, all those other things. And so once you realize gold is money, you're really asking, what is the dollar's value in terms of gold, not vice versa? And again, as anyone who's studied any monetary history knows, that all currencies begin as just an expression of the precious metal. So the dollar was defined originally as a certain weight of silver, and then of silver and gold, and finally gold. But it's the definition of it. It's not backed by it. It's the definition of it. And then the next step is that those two things get distinct, right? The idea of dollar was being backed by gold, having an independent value away from gold that the Fed can manipulate. And then now we are today, where basically the dollar is a fiat currency that floats on the whims of the market, supply and demand, and Federal Reserve policy. So the way I look at gold in dollar terms is really through the dollar. And what is a dollar? Again, today, the dollar is a unit of liability of the Federal Reserve. They create them through bank reserves and send checks to people for not working, and they can theoretically destroy them. Now they use that power very, very seldomly and very short term, usually, because bad things happen when you start taking fiat dollars out of a credit system. But that's what it is. So if you think about that framework, And you think, again, how did the Federal Reserve get going? Well, its first balance sheet showed gold roughly 80% of its assets. So its liabilities were backed by about 80% by gold. And the rest was short-term government bonds and other cash items and strange things like that. And then the history of the Fed is that 80% number just gets lower and lower and lower. So it got to about 50% to the 20s. That was that bubble. And then in the 30s, when the Fed raised the price of gold to $35 an ounce, or I should say lower the value of the dollar, the Fed's balance sheet got up to 84% of its assets. And so basically, by the late 40s, a dollar in your wallet was 84% backed by gold. Well, that's not bad. I mean, people are going to transact on that basis. And that's when the Keynesians took over. And again, this is all my writing to try to condense this, but the Keynesians printed, the conceit was that they could manage the business cycle, they could manage the price level by having the Federal Reserve, the central banks, buy government bonds. And by 1969, they bought so many government bonds, and we'd lost so much gold to Europe. It was illegal, it was a felony for Americans to have gold, but European governments could still redeem their dollars for gold, which they did. And so by the time we get to 1969, the peak of that bubble, the Nifty 50 and that whole thing, the Fed was backed by 12% gold. And then the way I view the 70s, and again, this is very idiosyncratic, which is why, it's different, but I think it's accurate. It wasn't that the Fed Reserve printed so much money in the 70s. They did. But the real story was that gold went from being 12% backed to 100% backed. And the way I look at it is pre-1930 central banks, when the central banks were committed to redeeming their currency into gold, you could show up at a central bank in Europe or the United States with paper money and say, at the central bank, all right, give me my gold. I'm nervous about your currency. And there were runs in central bank in Central Europe. You can't do it today. You haven't been able to do that since the 30s. But you can still go to the coin store and you can say, look, I've got these dollars. Well, I don't want the dollars. I want the gold. You buy at the coin store. And so the way the market stages a run on the central banks is by setting gold at a price that backs its liabilities. And what happened was in the 70s was by 1980, the market had lost such confidence in the Federal Reserve under Arthur Burns and Carter and Nixon and Ford, to be fair, that at $6.50 an ounce, and gold hit $8.75, at $6.50 an ounce, when it hit that number, the Federal Reserve liabilities were 100% backed by gold. And so the dollar in your wallet was 100% backed. So we were basically, the market had returned us to a gold standard. And no one else thinks of it that way. Economists don't, politicians don't. I've never heard anyone else express it that way. But that is, in fact, that's just math. I mean, that's just what happened. And then the monetarists took over, and they're just Keynesians by a different name, essentially. And that metric has now gone from 100%, over 100% in 1980. And by the way, that was not a good time to be buying gold. Once your currency is backed by gold, it's probably a good time to buy productive assets. That ratio is now down to about 6 or 7%. And so my whole thesis is that there is going to come a time when the central banks of the world and the Fed lose control of interest rates, lose control of the bubble they've created. And the way the market will stage a run on these institutions is by setting gold to a price that makes their balance sheets balanced. Now, it doesn't need to be 100%. That was excessive. But it does need to be, 30% was the average in the 19th century. That was normal times. And these are not normal times. So I could see 50%. I could see 2/3. I could see 100%. It happened before. It could happen again. And the Fed's current balance sheet, those numbers are well above $20,000 an ounce. That may sound crazy to some of your viewers, but just consider that in 1969, gold was $35 an ounce. And by 1980, it was $8.75. So it went up about 33 times in value in that time period. And the other thing to keep in mind as an investor is it was not a smooth move from 35 to 8.75. There were two periods in the 70s, two about 18, 24-month periods when most of the gains were experienced. And so when panics happen, they tend to be self-reinforcing phenomena. So you can't really wait in the market and say, I'll get on when I see the real panic happening. It's far too late by then. You've got to be already in the market.